Kenya has secured about 202 billion shillings in a fresh Eurobond issue on the same day that the International Monetary Fund stated that the country's public debt may soon become unsustainable. The National Treasury, with backing from Central Bank of Kenya, maintains that the level of public debt in the country is within acceptable limits and therefore is no cause for alarm. Hudhaifa Aiden takes a look at the irony of the day's event in relation to the debate on the public debt.
It was all smiles and handshakes after the National Treasury's senior officials, led by the Cabinet Secretary Henry Rotich, successfully oversaw the listing of Kenya's second Eurobond worth $2 billion, which is equivalent to about 202 billion shillings at the London Stock Exchange. The listing follows a series of roadshows in Europe and the Americas. The issue was massively oversubscribed. The Kenyan government sought to raise $2 billion, but instead got $14 billion, which is approximately 1.4 trillion shillings. But as officials from the National Treasury were celebrating the achievement, back at home, the International Monetary Fund was meeting with members of parliament to express its position on the state of the national debt.
And that debt burden is increasing rapidly, and therefore that's not sustainable to maintain these high deficits. So that has a concern about stability and sustainability of the whole macro situation. What we are concerned about is the flow of new debt. I mean, so the trajectory is going to a place where it will not be sustainable anymore and where you will get into trouble eventually.
A week ago, international credit rating agency Moody's downgraded the government of Kenya's rating to B2 from B1, assigning it a stable outlook. Moody's noted that Kenya's fiscal outlook is weakening with the rise in debt levels and deterioration in debt affordability. It further stated that the government's plans to improve the efficiency of spending and revenues are unlikely to be effective enough to stem the weakening fiscal trends. Debate on whether the national debt is in the red zone or not has put financial experts on different sides of the divide.
And one of the biggest challenges of the moment, to be honest, is our debt problem. Our debt on the one side and our revenues on the other actually going in different directions, which means our deficit is bigger. The reason I'm concerned here is because, and our cabinet secretary tends to be, to speak and very measured and temperamentally is suitable for the job, but I don't think he communicates sufficiently well to his bosses the precarious position of our debt, in my view. So that requires that the president understand that the debt position, and it's not something that people scream about because it's a good thing to scream about, our debt position is not a good one. It's very precariously balanced.
Look at 2012, we were at 41%. Look at 2016, we are at 50%. The acceptable number for an emerging population is around 50%. So we are already at what you'd call the ceiling. But the trend is worrying and needs to be addressed.
77% debt to GDP ratio in the year 2000. We're about 55, 54 now. You know, I always look at Kenya like a young adult. You've come through a certain stage of development and you've reached a stage now where you have 60% of your population below 30 odd years. And so if you don't invest now, if you don't create opportunities now, then what is going to happen? You have to take some risk.
The sovereign bond was issued in two equal tranches, one for 10 years at a coupon of 7.25% and the other for 30 years at a coupon of 8.25%. The government says the funds will be applied towards the government's development initiatives and liability management. Liability management is another term for repayment of debts. Kenya's short-term debt repayment obligations are mounting, and it is these that a chunk of Eurobond is expected to address.
Out of the country's total debt of about 4.4 trillion, about 1 trillion will be maturing in the next 1 year or so. And the government therefore needs to consider alternative avenues like public-private partnerships to reduce the appetite for borrowing.
A number of economists have questioned how quickly the heavy investment in infrastructure will pay back the loans to build them. A case in point is the standard gauge railway, where the government is said to be seeking to compel cargo importers rather than giving them a free hand to choose between rail or road. Opinion remains sharply divided on the country's debt sustainability. The launch of the second Eurobond comes at a time when questions still linger on the prudent use of the funds accrued from the inaugural Eurobond. However, one thing remains very clear. Borrowing from Peter to pay Paul is not a sustainable model, and the need to get off the debt treadmill has never been more urgent. Hudhaifa Aden, NTV.